Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Funds and Value Research. You must have heard many investment gurus tell you, stay calm when the market is volatile. How easy it is to follow this advice. This is what we're going to be discussing in today's Investors Hangout with the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
How important is planning when it comes to avoid the market volatility?
You can't avoid market volatility. Markets are always volatile. The definition of market volatility has been distorted. People like the volatility. They don't complain about it if the market is going up, because markets always go up and down. But if the general trend that it's going up, people don't mind that. Only when the markets go down, that people say markets are volatile. That is not volatility. Volatility is something going up and down, and that is the character of the market. That is how it will be. I don't think it is going to change. Now you have to configure yourself that when markets turn volatile and it's in a downward way, what will you do? Or are you geared for that? And for that you need to do few things, which is very basic, which we keep repeating in Investors Hangout time and again. And even at the cost of sounding like a stuck record, I would like to say that to stay calm in a volatile market or in a downward market, in a crumbling market, in that context we are referring to volatility, is that if you have done the basics, divided your long-term investment and short-term investment, investing only your long-term investments into equity or anything to do with equity. Investing into equity should be a periodic thing. It should not be a lump sum. And if you have done these three things, you will stay calm, because the problem is built only when you haven't planned for it. You randomly came into the market, you got greedy, you got inspired by the recent past performance, something did well, and you invested because expecting that it will continue, and then the market turns downward. That is when you panic. If you invest your short-term money, you will panic, because if you have your son or child going into college 8 months from now, and if that money is in equity, you have reason to worry. You should take, and you will panic. You can't stay calm. So if you have these basic rules in place, if you are following this basic framework of which money to invest and how to invest that, and then comes, which kind of vehicle to invest, because depending on your experience or depending on the criticality of the money, where you want to invest. So, if you have this basic foundation in place, you'll be okay. In fact, you'll rather feel happy when markets turn volatile, because if you're investing for next 10 years, then I would like the market to be in great difficulty for 8 years and do exceedingly well in the last 2 years when I need the money.
But you can't plan that.
But you can't plan that.
Yeah.
So what you can do is, if the markets go down, and if you're investing for 5-7 years, you are buying cheap.
Okay. What is the point on which I as an investor see that, volatility is happening, as you say, and it's going down? Which is that point where I should act?
Broadly, if you have followed the, if you have followed the principles of, how to divide your money, allocate your money,
the
and all that.
bucket system and all that.
Bucket system. But besides that, there are 3-4 things, because it depends on which cycle of your investment, which cycle, where you stand in your investment life cycle.
Okay.
Assuming that you have been doing this, you have been investing for 15 years, you have been investing gradually, now you have accumulated something sizable, and now you are going to invest for only 3-4 years. You are still in the accumulation phase, you don't need the money. That is the time when the markets go up, and assuming that, let me give you an example. You started investing 10,000 rupees a month, and that was a constant thing, and you kept doing this, or 12,500 rupees a month, the way you do it, like in PPF, you started doing it in a tax saving fund. And then the whole accumulation has translated into something like 1 crore of rupees after 15 years. Right. And you still don't need the money. You might need a part of that money 5 years from now. But when you see 1 crore of rupees going down in value by 10%, it becomes 90 lakh. You worry, you panic. You panic less because you have seen the whole accumulation. Had the money been in PPF, it would have been just about 40 lakh. But that's okay. You see that something which you could have realized, which was worth 1 crore of rupees, has in a span of 1 month has become 90 lakh rupees. That causes panic.
Okay.
So I think that there are 2-3 things to do. One is that have your goal orientation. Second is don't look at too much of news, because there is too much noise, and the news media is built around talking something very intensely. They're doing their job. The news is played up in a manner that it's scary. Likewise, the converse is also true. When the optimism grips in, then they try to build it that it's going to be a completely different world 6 months from now, 1 year from now, or magic is going to happen, which may not be the case. Likewise, the reverse of that is as true. That when just about a month back, it looks like there is a doomsday being painted, that oil price is going up and it will never stop. Rupee is depreciating and it will not stop depreciating forever. Industrial production will come to a standstill, or
very poor sentiments.
Very poor sentiment, and these sentiments swing very dramatically in a brief period of time, and this does not help, because business, you have to see that if you're investing for 5 years, 10 years, it's a general bet on economy. Will we be better off? Will we be consuming superior products and services, and companies will not only prosper but thrive? If you have that orientation, you have to ensure that some of the basics are in place. You are investing in a fund, or if you are investing directly, then you are diversified enough. You are not taking unusual. You have the usual checks and balances. What I referred in the first question, investing long-term money, this. Likewise, investing regularly, diversifying your money, and one critical thing which one should keep in mind, as we keep talking so much about investing for the long run and investing regularly. As you get closer to your goal, disinvesting regularly and realizing that money before you need that money well in hand. Touch this aspect, but this really doesn't. It does not dominate our mind. That is also a very important thing which will help you stay calm. Because you will be assured that your goals are not going to suffer. You will be not deprived of an opportunity of your lifetime plan not being put to use, because at the last moment you will be entirely dependent on the market.
It is said that the markets, when they are down, is a good time to invest. So what would your advice be for the young investors? It's volatile, stay away, or go into it?
No, as I said, that draw a plan, stick to it. And bad market is a good time to start, because that is the investments made at that, when you start there, you are more unlikely to go wrong.
I like what you said. 8 years, bad market, good. But 2 years should be.
You need to, but it's very hard to guess. I would expect that the market to be in a very terrible state and then do very well. And it happened once, if you look at what happened in the market from 1992 to 2002, market did not go anywhere. It did go up and down, but Harshad Mehta scam, 1992, market touched a high of 4,000. Sensex was at 4,000. We saw the big churn, the Great Indian Reform, everything changed. And once again in 2002, we were back to 2,800. Imagine 10 years, 10 historic years in which the country changed and the markets actually came down substantially. And this whole pent up of the market gains. Then we saw that in the next 6 years, 2002 to 2008, market went up from 2,800 to 20,000. So if you were able to, assuming that you had the patience to stay calm, assuming that there were vehicles where you could invest regularly, and a simple strategy would have been so rewarding.
Okay. It's inevitable that the volatility will happen, as you rightly said. Nobody can even predict.
That's a character
of the market. At times it goes down, which has we recently witnessed as low as 2%. So keeping calm, that's a human psychology. I mean, come on, how can I keep calm? I mean,
2% in a day.
Yeah. I mean, how can I keep calm? I mean, in such a situation, hand-holding is important, all that is important, seeking advice is important. What is important?
Two things. You have to really work on the manageables. You can't really worry about anything which you can't manage. You can do two things. One is watch less. Switch it off. Don't look at your portfolio every day. Don't look at, don't get bogged by, don't get gripped by this whole panic or the doomsday being painted. This other thing that you should do is take a practical approach to your asset allocation. Everybody thinks that, 8 months ago, we were getting questions that which is the best small cap fund to invest, because it went up by 80% last year, some of the good ones. So everybody wanted small caps. Now the big decline in small caps, everybody is worried and scared and just waiting to run away. It doesn't work like that. I think having the discipline to be in the right vehicle which will not scare you out of the market. For example, a person who has never invested in the market is extremely conservative, small investor, and so he should start with those equity income fund, even with his long-term money, where only a third of the money is in equity. Assuming some person has a little bit of experience and can still absorb the ups and downs of the market still, but has not been an experienced investor, he hasn't seen the market for a long period of time, he should still continue with, he should start with either a tax saving fund where you get stuck for 3 years, so you can't get out once you invest. So panic also won't drive you out of the market, which is extremely important. The other is that or balanced fund, if you don't need to invest for taxes, saving taxes, and then being in a multi-cap fund, keeping things simple, it helps, because what we find is that something which does exceedingly well is also the segment which does extremely poorly. For example, small caps did exceedingly well last year. Small caps did very well 2 years back. They are the best performing fund over the past 10 years or 12 years or 15 years long term. But if you recall what happened in 2008, they are the ones which went down by 80%. Your 100 rupee turned into 20. And that is scary. And most investors, so sector funds, extremely narrow focused volatile funds like the small caps, they can scare you. So they are not meant for everybody. They are not mainstream vehicle. Keep it simple. Equity income fund for starters, no experience, conservative. Somebody who knows a little bit, drifted into the market, tax saving or balanced fund or multi-cap fund, and that does the job. That does the job of your long-term investing.
So right vehicle is extremely important.
Yes.
And as you are reaching the goal that you have set for yourself,
taking money out beforehand,
money out
methodically,
in a systematic manner is extremely important, and that will help you to keep calm.